Good afternoon, everybody. So today we will look at a new topic and a new area. Today we will look at performance measurement and reporting on segments. Okay, right. Let's have a look now and find out what is the meaning of decentralization. Okay, now when I look at decentralization and centralization, they are versus each other. So centralization, where the business or the head office, right, has a control over all the business. But when decentralizations come into force, that the head office will focus only on the company strategy, the company goals, and they leave the lower managers or the middle level managers to work out on the segments. So that's the difference, the main difference. So when I look at, to be specific, when I talk about decentralization, what could be the benefits of decentralizations? Of course, when we talk about decentralization, we talk about the top management free to concentrate on strategy. So the top management, they have that they will set the company goals, they will set the company strategy and the strategic goal of the business, the strategic objective, and they will work on it. Okay, so they will not really uh, um, occupied and spend time on um, uh, on lower level managers, which they need to do the job. So the lower level managers gain experience in decision making. Of course, this is opportunity for them to gain experience, also opportunity for them to evaluate, to ability to evaluate managers in terms of who's good manager and who's is not good managers, which managers needs training, etc. Another interesting of the benefits of decentralization is that lower level decision, low level managers, of course, they take decisions based on better information. I mean, that's very interesting point here to make. For example, one of the interesting points here, if we talk about the restaurants, for example, McDonald's, KFC, these companies, for instance, the head office in the US, we know, and each country has also McDonald's almost. If you talk about India, for example, so in India that you sell beef is not allowed. So that's one of the things that these restaurants, they should be careful and, for example, don't sell beef because they will be in trouble, right? So again, that's what I'm trying to say. That's the way that managers there, they can evaluate the situation and they can take decisions based on better information. Of course, the head office in the US, they can focus on the strategy there, but when it comes to countries and cities, so the lower level managers can really do better in terms of information. On the other hand, indeed, no doubt that decentralization has some disadvantages, and one of them, as you see here, that when they take decisions, the lower level managers, they didn't look at the big picture of the business. So when you talk about the head office, so they can see the big pictures of the business. Well, what is the strategic objective of the business for the next 10 years? But when it comes to lower level managers, they look maybe the next year, next 6 months. And another disadvantage, of course, which as you see here, may not be those of the organization, the objectives. For example, when it comes to the managers, they might have different objectives and goals from the one in the head office. Again, these could be the two disadvantages. So now if we talk about segment here, what do I mean by segment? Segment is any part or activity of an organization, anything. So the manager can control cost, revenue, or profit. Anything, could be anything. It's called segment within the business. So now if you look here, we have cost center, profit center, and investment center. So what is the difference between cost, profit, and investment centers? Cost center, the manager, of course, is a segment. The manager only has control over the cost only, not the revenue, another profit, another investment, only the cost. When it comes to the profit center, the manager has control on both, which is the cost center and the profit center. Okay, so now when it comes to the investment center, so as you see, this is where the corporate headquarters, where the manager has control over cost, profit, and investment in the operating assets. So these three types of centers, the cost center, profit center, and investment center, are called responsibility center. Okay, so now let's have a look at fixed cost. Right, we have studied fixed cost, and you know what does that mean. Fixed cost, total fixed costs do not change with the production change. So, and one of the examples of fixed cost is the factory rent. Okay, regardless the business, if they are producing or manufacturing, every day they have to pay they have to pay 1,000, for example. So the question is, there are now two types of fixed cost we need to look at, and you need to understand. The first one, common fixed cost, which is the one you understand, you know it, and the second one is the traceable fixed cost. So what is the difference? When it comes to common fixed cost, it arises because of the business as a whole, yeah. But when it comes to traceable fixed cost, it arises because of specific division. There's existing division, and that's why we have a traceable fixed cost. Let's look at this example. So if we talk about this business, right, traceable fixed cost would disappear over time if the segment itself disappeared. Very simple, yeah. Okay, let's talk about any company in your mind. So they have computer. One of their divisions is the computer division. And of course, if they have computer division, of course they need to hire a manager. It's called division manager. If there is no computer division, would be division manager? No, wouldn't be division manager, and it wouldn't be a division manager's salary, which is salary is fixed cost. So this is a traceable fixed cost because it's related to the division manager, However, when it comes to the company, right, there is no division manager for the computer division, but we have the CEO, the chairman. And the chairman is what is a common fixed cost. It's not a traceable fixed cost, it's a common fixed cost. Why? Because regardless if there is a division manager for the computer division, or that if there exists of computer division or not, still there is a chairman, isn't it? And that's called common fixed cost. So can you see the difference, guys, here? So remember, of course, the common fixed cost will disappear if the company, of course, completely closed. So let's have a look at this example. This company has two divisions, as you see, the computer division and the TV division. Okay, so if you look here, you can see that we need to look more about the computer division. Okay, let's have a look. Oh, sorry, the TV division. Let's have a look. So when it comes, this is a statement of profit and loss for the TV division. And as you see here, we have the sales, we have variable cost of goods sold, we have other variable costs, total variable cost, blah, blah. And we've got a traceable fixed cost 90. So this is a traceable fixed cost. Why we call it traceable? Because it's related to the TV division. Yeah, very simple, isn't it? Yeah, fine. Yeah, fair enough. Now, how is related this TV division to the company? Okay, let's have a look. This is the TV division, which we just looked at. Statement of profit and loss. And this is the computer division also. And this is the company overall. So as you see, each division, 300, 200, equal 500, variable cost, etc. Contribution margin, traceable fixed cost, division margin. So this is the profit. This is the profit for the division, right? Each division as the company 100. That's fine. There's no problem with this. But what is the common fixed cost? The common fixed cost could be any cost, fixed cost, yeah, is not related to division straight away, is related to the company as overall. As I mentioned, could be one of them could be the CEO salary, could be the head office rent, yeah. There's a lot of them there, yeah. So this is called common cost. So for the business, when they have a lot divisions, for example, we talk about a huge company like Samsung. They manufacture a lot, many products, and indeed they use ABC in order to identify which costs are classified as traceable, related to specific division, and which fixed costs are classified as a common fixed cost. So this is the difference, and I hope that you understand it. Okay. Right. So if you look at the examples, we've got this example, and we've got the sales 100,000 here. The controllable cost 20,000, and and the head office cost 20,000, and the non-controllable cost 10,000. Okay, there's a lot of going on now. Okay, right. So first of all, you need to understand what is the difference between controllable cost and non-controllable cost. Okay, controllable cost, which the division, I'm talking about the division here, focus on this, can control. Yeah, they have the power to control this, 20,000 pounds. Such as, give me examples, think the division can control the labor wages. Yeah, they say, look, I'm going to pay £10, £9, £15. They can control it, isn't it? Very simple. Also, another one could be, for example, I don't know, but could be anything else they can control, isn't it? These controllable costs. The non-controllable cost, the division non-controllable cost, is the cost that they cannot control, right? They cannot control. They have no way to control it, isn't it? Think about it. Think about something. I would say insurance. Yeah, if they want to insure the division, yeah, of course, this is non-controllable. That's how much the insurance company will say they will pay. Another one could be the rent. Yes, the rent, another example, that how much rent they will pay. The division, I'm talking about the division. So as you see, they don't control it, right? So these are the difference, guys, between the non-controllable and controllable cost. Of course, the £20,000 here, this is, of course, from the head office. When you when you see the head office, straight away, you think about what? You think about the common fixed cost. You think about the common fixed cost. So if you look at this example, very simple. Just you need to plug numbers. So sales revenue 100 minus controllable cost 20, and controllable profit 80 minus the non-controllable cost 10 equal profit contribution for the division 70, right? And at the end, of course, you need to deduct the common fixed cost, 20, so that gives you 50 overall. Okay, dokie. Right. So now, guys, we will look at a 3 type of divisional performance measures. Now, when it comes to the divisions, right? So of course there is a manager for each division, and this manager, the company evaluate their performances based on some metrics. Forget about the salary. I'm not talking about the salary. I'm talking about the bonus. Okay? Did they do well on the business or they didn't do well? We have 3 metrics here. We have return on investment, we have residual income, and we have economic value added. For the interest in this lecture, we are covered by return on investment and only residual income. Economic value added, there is a material. I bought a lot of materials for you to use on the slide and also some documents, but for the sake of the exam, it's not required from you. So this is additional information, additional knowledge you can read and you can study it. Okay, but again, we will focus only, and you will be expected to be assessed in the final exam on ROI and RI only. Okay, good. Let's start with return on investment. Very simple. Return on investment, one of the measures. Okay, they evaluate the company or the division performance, and this is the formula, which is operating profit or profit before interest and tax divided by average operating assets. If you look at the average operating assets, it includes cash, trade receivables, inventory, and others. And also could be another formula, which is operating profit or profit before interest and tax divided by capital employed. Another formula could be, because it can replace each other. So average operating assets is another term for capital employed. Okay, this is only one example you can look at, and that example shows you how to calculate return on investment. So as you see in this question, we have the operating profit 330,000, average operating profit 200,000, and the sales 500,000. So very simple, really. You just apply the formula, which is the 330,000, which is the operating profit, divided by the average operating assets, which is 200,000. So that's 15% return on investment. So if you look here at 15%, what does that mean? This means that the division managers will not accept any project unless what? Unless there is a return of 15% minimum. Even if this percentage contradicts with the company's percentage. And we'll look at this in a bit. Okay, so what does that mean? This means, oh, right. This means the manager, the division manager, will love to see return on investment high, yeah? Because they can access more bonuses, isn't it? And that's why a lot of manipulation, guys, will come into force when it comes to this. And the managers try to increase this percentage in order for them to access for more bonuses. So there are some ways to increase it, and as you see, if you reduce expenses, of course, if you reduce expenses, what does that mean? This means operating profit will be more, and as a result, so that percentage will be more, isn't it? if you increase sales, the same. If you increase sales, that means operating profit will be more, and as a result, so the return on investment will be more. If you reduce assets, yeah, as you see again, so the average operating asset will be less, and as a result, the percentage return on investment will be more. And these simple ways the manager can play with in order to maximize the ROI. Okay, fine, fair enough. Now, again, another example, we'll look at ROI. As I mentioned, the formula, which is profit before interest and tax divided by average operating assets or capital employed. So remember, in the question, you could have capital employed or you could have average operating assets. So remember this. Right. Now, let's have a look at this example. Example 2. The capital employed is 30 million. The annual profit 6 million. And the cost of capital 10%. Fair enough. Okay. Apply. So what is the annual profit, which is the profit before interest and tax? 6 million. If you divide it by the capital employed, which is 30 million, and of course times 100%, so that gives you 20%. 20%. Right. So this means the company or the division will accept this project. Why? Because the cost of capital is 10% per annum, and this is above it, so this means they will accept this project because above their benchmark. So what is now the what we call it, the criticism of ROI? So one of the criticism really that it create lack of goal congruence between the managers and of course the strategy of the company. And the second one, which is related to the first one, we can connect it, that managers evaluated in ROI may reject profitable investment opportunities. So if you look at the first two points here and think, what's going on here? What's going on? Okay, I'll tell you what's going on. Let's have a look at this example. You will understand what does that mean really. As a division manager at Swansea PLC, your compensation package includes a salary plus bonus. And the bonus, as I mentioned, based on what? Based on your division's ROI. So the manager, so basically they evaluated their performances based on ROI. Of course, the higher your ROI, the bigger your bonus. The company itself requires an ROI of 15% on all new investments. So any investment which has 15% or more as a return, we are happy as a business, as a company, as a head office. Fine. However, your division has been producing an ROI of 30%. So what does that mean? This means any project, any investment opportunity has to be 30% minimum as a return. Why? Of course, because the manager wants more return, wants more profit, more bonus, isn't it? Fine. There is a project right now. There is a new project, and this project that will produce an ROI of a 25%. Okay. So as a division manager, would you invest in this project? So what do you think? For 15 seconds, 10 seconds, you said, of course not. Why not? Not because it's below my benchmark, right? As a division manager, I said, okay, I'm not going to invest in any project with less than 30%. Fair enough. If there's a project 25%, I'm not going to invest in it. Fair enough. However, as you see, this 25% is above the company's head office benchmark 15%. So can you see what's going on? Can you see the lack of goal congruence? Can you see the lack of strategy? Can you see that they might reject some profitable opportunities? Yeah, and that's why they are not interested. They are interested in their bonuses and their division, but they are not interested for the company as a whole. So as a division manager, I wouldn't invest in that project because it would lower my pay. But of course, I thought we were supposed to do what we was best for the company, and that's the point here, guys. That's the point here. And from in terms of questions, if you in the exam, so remember that you should discuss the figures, and you should discuss the difference that the two views from the company's points of view and the division manager's points of view. Okay, fair enough. So the second measure we will look at today, residual income. Okay, so residual income and economic value added, they are both, they have the same mechanics, the same strategy, but residual income we use in accounting, economic value added usually used in economics more. Okay, so as I mentioned from the beginning, we will look only at residual income, and this is what you're going to be assessed. Right. Okay. So this is the formula for residual income. Okay. Operating profit minus average operating assets times minimum required rate of return. Again, average operating assets is the another term of what? Of capital employed. Okay, fair enough. Let's have a look. So if you apply on this example, you can see that this business has £100,000 operating assets and required to earn a return of 20% on these assets. In the current period, the division earns £30,000. So if you look at these figures and apply it, so you can see that the formula, which is 30,000 minus, opening bracket, the 100,000 times 20%. So anyway, if you do the math, you can see that there is a £10,000 residual income, positive number. Okay, we'll look at it in a bit. So as you see here, the £10,000 here is positive. So from this point, you see, okay, as a manager, a division manager, if it's positive, they have no choice. They have to accept it. That's it. It's like net present value and PV. If it's positive, accept the project. Negative, reject the project, isn't it? Yeah. So as a manager now, they do not compare it with other divisions. It's not comparable because, okay, great. So you've got £10,000 profit from this project. Okay, just accept it. There's no excuse not to accept it, really. Yeah. And that's why when it comes to residual income, you can see that residual income is what? Is absolute measure. Is an absolute measure. And that's why makes it really not preferable for the division managers. And the residual income comes as a result of the disadvantages, really, and the problems, the issues of ROI. Okay, let's have a look at another example of residual income. So if you look at this example, you can see that we have capital employed 30 million, we have annual profit 6 million, and the cost of capital 10%. Okay, fair enough. Clear, I guess. It's clear. Fair enough. Apply then. Go. So you will see that the annual profit minus imputed interest charge on net assets is the same. That's another term, guys. So 6 million, which is the annual profit, minus times open bracket 10% times 30 million. So as you see, is a 3 million pound. 3 million pound. And as you see from this, that the residual income is an absolute measure. And as you see here, that it is not comparable, it's not percentage, which you can compare it with other division. So the manager has no choice just to accept it if it comes to be positive. Okay, right, okie dokie. Now let's have a look at this example 3. So this example 3, the question asks you to calculate the ROI and also RI. Okay, and this is one of the things you're gonna expect in the exam, the final exam. Okay, it's gonna be scenario, and you need to calculate both ROI and RI, and after that you need to comment on the results. So commenting on the results is the key, and you need to understand the results in order to comment. For this example 3, as you see, we have capital employed 30 million, we have annual profit 6 million, cost of capital 10 million, 18%. Fair enough. Okay, apply. Using the data from above, recalculate ROI and RI. The capital employed has reduced by 5 million simply because the assets have aged 1 year. Anyway, let's have a look at the first 10. Okay, so 30 million, let's start with ROI, guys, okay? 6 million, okay, divided by 25, isn't it? Why 25? Because the capital employed was reduced by 5 million. Fair enough? Fair enough. Yeah, so what is the percentage here? 24%. So the return on investment is what? Is it 24%? Fair enough. Now when it comes to residual income, the RI, so you can see that the annual profit, if you apply the formula, which is 6 million minus opening bracket, which is 25 million times 10%. So, and at the end it will give you 3.5 million pound. 3.5 million pound. So again, and again, when it comes to the exam, I will give you a new project, and you need to do the comparable between the two metrics in order to choose and talk about the two views from the company's point of view and the division manager's point of view. Okay, so at the end of the day, you need to understand that the motivation of this residual income to what? To encourage managers to make profitable investment that would be rejected by manager using ROI. This is the aim, right? And that's why now the company head office started to realize this and started to choose and make the ROI is the performance metrics other than the ROI. So ROI was more preferable in this case because, as you see, less manipulation there. Okay, so it's very simple. If you've got the project and you've got the two metrics, which is ROI and RI, so it's very simple. You could see that it could be rejected using ROI, but could be accepted using RI, and that's what it comes with residual income and y is more preferable in this case. Okay, so again the question is, and why the residual income approach cannot be used to compare the performance of divisions of different sizes, as I mentioned, because it's an absolute measure, is not a percentage. It's not a percentage which you can compare between the divisions. Okay, right. Okay, guys, that's all to do with division performance measures. Nice topic, interesting topic, simple topic. Of course, simple, but remember that you need to work out and find out the comments when it comes to the exam. So this figure, what does it mean? And this figure, what does it mean? And you need to understand the two techniques or metrics carefully in order to do well in the exam. That's from me, guys. Thank you very much and have a lovely day. God bless.